$250,000. That's the exact point where your bank stops being obligated to protect your money. Not $249,000, not $251,000 rounded down to something friendlier. $250,000 to the dollar and every cent you keep above that line at a single bank in a single ownership category is sitting there with no federal protection at all. Most people watching this have crossed that line at least once without knowing it. You rolled a 401k into an IRA and the cash sat in one account for 3 weeks while you decided where to put it. You sold the house and the proceeds landed in checking before the closing dust settled. You inherited money. You watched the market swing and moved everything into one place because one place felt safer than three. In 2023, 3 American banks collapsed: Silicon Valley Bank, Signature Bank, First Republic. Roughly $550 billion in combined assets, gone inside a matter of weeks. And here's the only reason the depositors above that line didn't lose their money. The federal government made an extraordinary decision to cover them anyway. A decision it was under no obligation to make. A one-time call. They made it once. Nothing in federal law says they'll make it again. So before we go any further, I need to be straight with you about who's actually behind this number, because almost everyone gets that part wrong, including the people telling you about it. Let me tell you exactly who I'm talking to right now, because this is not a general warning. This one has a shape, and the shape is you. If you turned in your retirement paperwork in the last 2 years and rolled a 401k into an IRA, that money moved as a lump sum. It didn't trickle, it landed. And for however many days or weeks it took you to decide where it belonged, the entire balance sat in one account at one institution. If you sold a house, a paid-off house, maybe the one you raised your kids in, and the closing wired you $300,000, $400,000, $500,000, that money went somewhere. It went to a bank, and it sat. If someone died and left you money, an inheritance doesn't arrive in convenient installments. It arrives all at once, usually at the worst possible moment emotionally, when checking your deposit insurance coverage is the last thing on earth you're thinking about. If you had CDs laddered across 3 or 4 banks, the way you were told to do it, and then 2023 happened and it scared you, and you pulled them together into one place at one bank because consolidating felt like getting organized, felt like taking control. That last one is the cruelest because the instinct was right. Simplifying your finances in retirement is genuinely good advice. Fewer accounts, fewer passwords, fewer statements your spouse has to untangle if something happens to you. Every financial planner in America will tell you to consolidate. Almost none of them will tell you what consolidating does to your federal deposit insurance. So do me a favor. Type your age in the comments if you've ever had more than $250,000 sitting in a single bank, even for a week, even for a day, while a transfer cleared. I think the number of people who've crossed that line without ever being told about it is going to surprise everyone reading, including you. And I'll say this once up front, I'm not a lawyer, I'm not a CPA, and I'm not your financial advisor. What you're getting here is education. The rule, the number, and what it actually does. What you do about your specific accounts is a conversation for a professional who works for you and knows your situation. Take this as the warning. Take the specifics to them. Now, the agency behind this number is not who you've been told it is. You may have seen this rule described as an IRS rule, a new IRS rule, something the tax agency just rolled out to catch retirees sitting on too much cash. That is wrong, completely wrong, and not in a small way. The IRS has nothing to do with this, nothing. This is not a tax rule. It will never appear on your return, and no tax preparer is going to catch it for you. The agency that runs this number is the FDIC, the Federal Deposit Insurance Corporation, and it is a banking regulator, not a tax collector. Different agency, different law, different purpose entirely. And the second thing you've been told wrong, it isn't new. The $250,000 limit was written into the Dodd-Frank Wall Street Reform and Consumer Protection Act, and made permanent on July 21st, 2010, 16 years ago. Before that, it had been a temporary emergency number since October 2008 during the financial crisis. And before that, you're going all the way back to 1980. The federal insurance limit on your bank deposits was $100,000. Look at the whole history for a second, because it tells you something. It started at $2,500 in 1934, $5,000, $10,000 by 1950, $15,000 in 1966, $20,000 in 1969, $40,000 in 1974, $100,000 in 1980, $250,000 in 2008 as an emergency measure, made permanent in 2010. That limit moved 7 times in 46 years, and then it stopped. It has not moved once since 2010, while the cost of everything you buy has. So here's exactly how the mechanism works, because the details are where people get hurt. Your coverage is $250,000 per depositor, per FDIC insured bank, per ownership category. 3 separate qualifiers, and each one matters. Per depositor means it follows you, not the account. Per bank means it resets when you change institutions pile, but it does not reset when you open a second account at the same bank. That's the part that catches people. 2 checking accounts, a savings account, and a CD all at the same bank, all in your name alone. Those don't each get $250,000. They get added together and share one $250,000 limit. 4 accounts, 1 ceiling, and per ownership category. Hold on to that one, because it's about to become the most useful thing in this entire video. Now, what actually happens if your bank fails and you're above the line? The word people use is uninsured, and that word is doing a lot of damage because it sounds passive. It sounds like a gap, like the money is just sitting there unprotected, waiting for you. That is not what happens. When an FDIC insured bank fails, the insured portion, everything up to $250,000, is made available to you fast, typically within days. That part genuinely works, and it has worked without a single depositor losing insured funds since 1933. The amount above the line does not follow that path at all. It stops being a bank deposit and becomes an unsecured claim against the failed bank's receivership. You are no longer a customer. You are a creditor, standing in line with other creditors, waiting on an estate being liquidated by a federal receiver. You may get some of it back. You may get most of it back. You may get a fraction. It depends entirely on what the failed bank's assets are worth once they're sold off. And you find that out at the end of a process that can take months, and in some cases has taken years. Read that back and picture the timing. You're 71 years old. The money that was going to fund the next 20 years of your life is now a claim number in a federal receivership, and someone will write you a letter when they know more. So the $250,000 limit isn't really a limit on protection. It's the line where your money changes what it legally is, from a deposit into a claim. But that line has more give in it than almost anyone realizes, and it's built right into the rule itself. That third qualifier, and per ownership category, is not a technicality. It's the door. Here is what almost nobody does after learning about this number. They assume the answer is to move money to another bank. Open an account across town, split the balance, drive to 2 branches instead of 1. You can do that. It works. But you may not have to move a single dollar, because that third qualifier per ownership category means the FDIC does not count your money once. It counts it by category, and the categories stack. Same bank, same branch, same institution, and each category carries its own separate $250,000 limit. Start with the one most couples already have and don't understand. A joint account is covered at $250,000 per co-owner, not per account, per owner. So a joint checking account held by you and your spouse is federally insured up to $500,000. And that coverage is completely separate from whatever either of you holds individually at that same bank. Then retirement accounts. If you hold an IRA at your bank, like a certificate of deposit inside an IRA, a money market inside an IRA, That account sits in its own ownership category with its own $250,000 limit. It does not get added to your personal checking. It does not touch the joint account. It stands alone. And then the one that does the heaviest lifting, and the one virtually nobody has set up correctly. Revocable trust accounts, which includes the simple payable-on-death designation, sometimes called a POD, sometimes an in-trust for account. Every named beneficiary on that account adds another $250,000 of coverage to it. Not the account, each beneficiary. Let me put actual numbers on this because this is where it stops being a rule and starts being money. Take a retired couple, one bank. They're not moving anywhere. They have a joint checking account, $500,000 of coverage, $250,000 per co-owner. He has an IRA at that bank, another $250,000, its own category. She has an IRA at that bank, another $250,000. That's $1 million in federally insured coverage before they've done anything unusual, just by holding money in the categories they already qualify for. Now they open one more account, a payable-on-death account, and they name 3 beneficiaries, 3 children, 3 grandchildren, doesn't matter. In 3 named beneficiaries, that single account carries $750,000 of coverage. One bank, one couple, $1,750,000, fully insured. No second institution, no driving across town, no complicated trust drafted by an attorney. And the couple sitting on $400,000 in one checking account, the ones lying awake about it, could be fully covered by Friday using the exact same bank they already use. You thought $250,000 was your ceiling. It isn't. It's just where most people stopped reading the rule. Now, go back to 2023 for a second, because there's a reason the people who lived through those bank failures got their money back, and it's not the reason you think. March 2023, Silicon Valley Bank went down in about 48 hours. Signature Bank followed 2 days later, First Republic in May, roughly $550 billion in combined assets, gone in a matter of weeks. The second, third, and fourth largest bank failures in American history stacked into a single spring. And a very large share of the money in those banks was above the line, uninsured. Legally, those depositors were creditors in a receivership the moment the doors closed. They got paid anyway, all of them. Every dollar, insured and uninsured alike, not because the law required it, because federal regulators invoked a systemic risk exception and made a decision, an extraordinary discretionary decision, that covering uninsured depositors was necessary to stop a wider panic. It was a judgment call made under pressure in a specific set of circumstances. That is not a guarantee. It has never been a guarantee. There is nothing on the books, nothing in Dodd-Frank, nothing at the FDIC that entitles you to that outcome. The rule on the page still says $250,000. And I want to be careful here because there's a version of this video that tells you your bank is about to fail and you should be afraid. That's not what I'm telling you. Bank failures are rare. The FDIC's record is genuinely remarkable. Since 1933, not one depositor has lost a single dollar of insured funds, not one, in over 90 years. But look hard at which word is carrying that sentence, insured. The guarantee is bulletproof, and it stops at a line that hasn't moved since 2010, a line Congress has not raised before or after the biggest run of bank failures since the financial crisis. Nobody conspired to leave it there. It just wasn't anyone's priority. And that's the part that should bother you. Not that someone is coming for your money, but that the thing standing between your money and a receivership queue is a number no one is going to call you about. I want to know what you think about this one. Do you believe regulators would cover uninsured depositors again if a large bank failed tomorrow? Yes or no in the comments. I read them, and I suspect this room is going to split hard, because whichever way you answered, you shouldn't have to find out. So let's fix it. 3 moves in order of how little effort they take. Move 1, and start here because it costs you nothing. restructure inside the bank you already use. You've already seen the math, joint titling, an IRA in its own category, a payable-on-death designation with named beneficiaries. For most couples, that alone lifts coverage past $1 million without opening a single new relationship, without moving money, without a lawyer. It's paperwork at a branch, an afternoon. Move 2, use a second bank. Coverage resets completely at a separate FDIC insured institution. That's what per bank means. 2 banks, 2 full sets of ownership categories. If you're holding a genuinely large balance, this is the cleanest protection there is. Just confirm the 2 institutions are actually separate charters and not 2 brand names owned by the same bank, because if they share a charter, they share your limit. And credit unions count here too, with one wording change. They're insured by the NCUA rather than the FDIC through the Share Insurance Fund. Same $250,000 limit, same per owner and per category structure. Move 3, if a large sum needs to sit in cash for a while, deposit sweep networks exist. These are programs offered by some banks and financial firms that automatically distribute a large deposit across a network of partner banks, so a single balance can carry insurance coverage into the millions while you deal with one statement. I'm deliberately not naming providers or recommending one. I don't know your situation, and I'm not selling you anything. Know the category exists and ask your bank whether they offer it. Before any of that, do this one thing tonight because it's free and it takes 5 minutes. The FDIC runs a tool called EDIE, the Electronic Deposit Insurance Estimator, on FDIC.gov. You enter your actual accounts, how they're titled, and who's named on them, and it tells you precisely how much of your money is insured and how much is exposed. Not an estimate from a video. Your real number from the agency that would be writing the check. And use it rather than assuming, because 2 things trip people up. A payable-on-death designation only counts if it's formally in the bank's records. Your will does not create FDIC coverage. And naming the same beneficiary across several accounts does not multiply your coverage indefinitely. ED accounts for both. If that tool shows you $1 of exposure you didn't know about, share this with the person who'd be untangling your accounts if something happened to you. They need to see that number too. This is not a maybe. It's not a proposal, not a rumor, not something being debated. It is federal law, sitting exactly where it has sat since July of 2010, and it does not require anyone to fail or defraud you for it to matter. It just waits for someone to consolidate one large deposit without checking the paperwork. And nothing in the system will flag it for you. Not your bank, not your statement, not your tax preparer, because it isn't a tax issue. So do it yourself right now. Open your banking app. Add up every account you hold at that one institution. Checking, savings, money market, every CD, not what you think it is. The actual total. If that number starts with a 2, a 3, a 4, or anything higher, yes, you have about 5 minutes of work to do today, and you now know exactly what it is. Now, $250,000. Not a typo, not a rounding convention, and not a number anyone is going to negotiate with you about at the moment it starts mattering. It's a line drawn in 2010 that hasn't moved since. And every dollar you keep sits on one side of it or the other. The only question left is whether you know which side yours is on, and whether you decided that or a paperwork default decided it for you. You have the number now. Go find out.